All right, here we are, Monday morning, President's Day. After a big Daytona weekend, we have a special guest with us at Crossroads Consulting XR Insights. Got Mr. Steve Davis. Welcome, Steve.
Thank you for having me, Bill.
Yeah, Steve is with Liberty Run Benefits. I've had the fortunate experience to work with Steve for, oh God, what, 10 years now?
Yeah,
12
yeah.
years?
11 years, I think, 2013
Yeah.
probably. Yeah, man.
Yeah. So you and your team always take care of our clients on the benefit side. So it's much appreciated. We want to bring Steve in today because he just has a lot of information and a lot of experience in the employee benefit arena. But first, let's talk about some exciting family news. Your nephew, Garrett, had the opportunity to race in the ARCA race this Saturday with NASCAR. That had to be pretty cool.
That was amazing. Said it was the best experience of his life, going 195 miles an hour and, beside a car that's feels like it's loose and coming a foot from you. He said that was an interesting experience. So he didn't make it too far into the race, but he'll be back for sure. I think he's already scheduled to go to Talladega, and he's pretty excited about it. So
yeah, I mean, he's been racing cars forever, and I'm sure a lot of the people that were in the field in ARCA were. But I also heard a lot of scuttlebutt that they really dropped the experience and quality of the drivers, like they were really trying to field it. I mean, I know from what I've seen of Garrett, he definitely can drive, and got caught up in a little accident there.
Right. Luckily, he didn't cause the accident.
Yeah,
someone got sideways in front of him, and he just, like he said in his exit interview there, he zigged when he should have zagged, and I think that's part of the deal, right? You have to pick am I going to try to go under this or over it or whatever?
Yeah. And you got a 50-50 shot.
Right. Yeah. Right. So, but yeah, he came out of a couple before that and kept running, but that one, the car was not salvageable after that. So
yeah. Well, that's cool. Was that your first time over at Daytona?
It was actually first time in the track, and since I had the nephew, I got the hookup to pit row and stuff like that. So that was kind of neat being on the infield side and having access to see how the pits work and things like that. So pretty neat.
I was fortunate enough when I was 19 to be on a NASCAR team, be the gas man for a season and a half.
Nice.
So that was a lot of fun. Definitely a lot of fun. It's evolved a lot since 1987.
Right.
But that was definitely a neat experience.
Absolutely. Yeah. He's I wish him well. I think he's gonna do good, and I think he'll be good for NASCAR as well too. So
yeah. And you recently released your first book?
I did. Yeah, absolutely. I wrote a book called The Last at Bat, and I was a former Army Ranger. We have a Ranger creed that we pretty much live our lives by, and I saw some other books from other branches of military kind of geared toward kids or teens. And I thought, why hasn't anybody kind of tried to write a real world story using the principles of the Ranger Creed? So wrote a story about an elite baseball team, kind of like the elite unit in the Army, kind of the equivalent, and what it takes to try out and compete and win with an elite team. So hopefully there's some lessons in that book that can positively impact some people, was my goal.
That's awesome. That's awesome. I've seen you got a lot of 5-star ratings on that, and people like it.
Yeah, good feedback, and that was really the goal, not to make a ton of money, just to put a positive message out there, and hopefully it'll impact some people in a good way. So.
Well, since we've met, you've done kind of a lot of firsts, right? That was your first book. You did. I think when we first started working together, your goal was to climb all the 14ers or something. And then you recently did Machu Picchu and all this stuff.
So close. Some of those are still on the bucket list, but yeah. So I was stationed at Fort Lewis in Washington State. So I always saw Mount Rainier in the background, and always said I'm going to climb that one day. I didn't know I would wait whatever 30 years to do it, but finally the time was right. You know, in the time in my life where I had the resources and the time to do it. And so started with Mount Rainier out in Washington State. And then my wife and I did Mount Kilimanjaro a couple years later too, and that which is the highest, which is one of the 7 summits and the highest point in Africa as well too. So, but probably we'll stop right there. Not sure if I'm going to go for many more of the 7 summits because they all get progressively more dangerous after that. So,
Yeah, no Mount Everest.
too many uncontrollables, man. You know, I would love to do it, but there's just, you know, it could be a beautiful sunny day, and an hour later you could be stuck in a blacked out.
Yeah.
You know, I was just
Too many
on YouTube the
uncontrollables.
other night. I was just on YouTube the other night watching the Mount Everest documentary on one of the most dangerous treks up the mountain. It didn't end so well, but yeah, the storm, the weather changed so incredibly rapid. Hurricane force winds at the top of this mountain is just incredible.
Listen, we had this. We were working for the same company way back, and we had this sales conference, and they brought in this motivational team,
Right?
And it was the guy that you know, that had a team at Mount Everest.
Right.
So it was a 3-day workshop with these guys, and we had to do all these, you know, life experiences and relate them to work, and it was really good. It was going great until the end, when the guy said that their team made it 500 feet from the summit and had to turn around.
Oof.
They kind of quit.
They and so they were, you know, I mean, they were great people and everything.
Yeah.
But the kind of the joke going around our company then was, well, I mean, I brought a deal to the table just because they didn't sign the contract. I get credit, right?
Right.
You should get paid.
I got all the way to the signature page, and then they decided not to do it.
Yeah. Still counts a quota. I still should get a spiff. You know?
Yeah. Honestly though, to have the discipline to turn around when that, you know, your dream and goal is, you know, right there, you can see it. That's probably more impressive, man. But that's, you know, that's I think they're told you listen to your guides. You know, your guides, you're probably not going to be in the right state of mind. So whatever your guides tell you.
Well, and I'm sure 500 feet at that point is like 5 miles.
Yeah, right.
You know, I mean, we were chuckling. 500 feet,
right? Yeah, I can just sprint up and touch it and come back down. Right?
Yeah, but just one step. That next step has to be.
Yeah.
You know.
Yeah, no doubt about it.
All right, cool, man. Well,
good.
You know, congrats on some of your achievements. It's been
Thank
pretty
you.
cool.
Appreciate that.
We'll dive into this, but you know, today we just want to talk about the healthcare industry. You know, what you're seeing out there, and some of the challenges, and I know, you know, Jeff focuses heavily on the health with our clients, and
dealing with health insurance feels like climbing Everest.
Right? Sometimes it can be. You're right.
Yeah.
I mean, the options and you know, the challenges today. Of course, Billy and I spent a lot of years in the PEO industry, over 30 each of us, and so we're familiar with that private side of the health insurance side. You're very familiar with the open market side of it. But we're seeing a lot of underwriting challenges in the PEO model with the CurveRx database, the gradient scores. You're seeing a dramatic change in the PEO world as it relates to their master group medical, and the ability for small businesses to actually be approved and get into the PEO master group medical. So it's becoming more and more important to have people like yourself to find alternative solutions. What are you seeing, just to get things started, what are you seeing in the health insurance arena that's affecting small groups?
Yeah, so in small group, in the open market, Jeff, it's still strictly demographic driven on fully insured side. Okay, so the 3 factors are going to be average age, it's going to be male female population, and then it's going to be home zip code driver, and the most weighted of that is average age. Okay, so that's going to be the biggest impact. So Yeah, so in the fully insured market for small group, which most carriers call that 2 to 50 employees, right? To eligible employees. That's going to still be demographic driven. So that's either good news or bad news, right? Because the challenge in my world sometimes is getting a quote to somebody that's based on an assumed enrollment, right? You try to come as close as possible, but final rates are always going to be based on the actual enrollment, okay? And that's on the fully insured side. Now, we are seeing things like level funded come about, and we're seeing that gain more traction. And we as an agency are writing more and more level funded. And then the good news and bad news on that is that it's underwritten as well too. So if you've got a younger, healthier group that looks really good to underwriting, and they are using a lot of AI tools and RX tools now to see kind of what's going on in that group or that population. But when you have the right population with the right demographics and the right, I guess, lack of conditions, the level funding has becoming really aggressive in the marketplace. And when it's a good fit, we've seen some groups move to that as well.
Yeah, we're seeing more and more smaller groups going with level funded. Billy and I had a case a few months ago, private equity backed portfolio company, and they really had a challenging group, and we were looking at a level funded. Of course, they had to do personal health statements, and that revealed an awful lot. What was interesting about that, Steve, is the prescription drugs weighed extremely heavily in the risk profile of that group. There was one person that was using a drug that cost $7,000 a month. It almost appears like there's a little bit of a war going on between big pharma and big insurance. Big insurance is not wanting to pay for these very expensive drugs. They have the formulary list that breaks it down into different categories for drugs, but they're also raising premiums significantly because of prescription drugs. Are you seeing some stuff along the same line?
It's a constant battle. It's the same thing with providers, insurance companies, right? They all have kind of like their motives, and the doctors a lot of times are saying, hey, I'm treating the patient, I know the best course of action. But the insurance carrier is saying, hey, well, we have a fiduciary responsibility to control costs, and we're going to either you need to try this procedure first before that, or in the case of prescription drugs, they'll have a step program or something like that where you have to try these generics first and things. So we're seeing always a constant battle between those people providing the services or prescribing the prescriptions and the drug companies and insurance companies all kind of battling, to find that good balance between, effective and efficient care versus, costs as well too, and keeping premiums low. So that's a constant challenge. And it's becoming more and more burdensome for a business owner, to sustain that. In the small group market, obviously they're only restricted by a carrier rule of their employer contribution. But then when you get into 50 plus, groups where you have still under the Affordable Care Act mandates, then they actually have to make the coverage quote unquote affordable for the employees, and that changes every year. That's defined by the IRS, and that's kind of a moving target year to year as well. So.
Yeah, if we can stay in the under 50 market for a moment, it also looks to me like the government exchange is competing with small groups on a participation basis, because what we're finding is younger people can go to the exchange, get a subsidy, whether they do it legitimately or they put in improper data. Correct. That allows them to qualify for the government subsidy, even though the employer may have an affordable option. Right. It is impacting the participation. Are you seeing carriers still kind of holding a hard line on the 50% participation, or is there some wiggle room there?
So it's funny you say that. So typically on an install, they're still, they're not asking for proof yet. Let's put it that way. So to answer your question, Jeff, the exchange can impact the individual market, maybe not necessarily on a participation standpoint, but definitely on a rate position. So a couple things. So let's talk about participation first. So when we write a small group, an individual plan is a valid waiver. Okay. So that doesn't count against you for participation. So typically it doesn't affect us on, that the group didn't meet participation and that we're going to, not put coverage in place. Typically we get coverage in place. The more impact that has is that 22-year-old or 23-year-old that's getting their subsidy in exchange. That's who you want on your insurance plan because it's demographic driven. That's who you want on your insurance plan. And what we see more and more today, we call it the death spiral or whatever in rates, where you get just your older people on the plan, right? Because as you know, on the exchange, the rates are driven by your age, right? So a 25-year-old is going to have a much less expensive rate than a 55-year-old. So when you have the group plan, that brings those average rates to a median, basically, right? The middle of your population. So the older people, it's a great deal for them. It's not as good a deal for the younger people. So what happens is you end up with typically your older people on insurance, or those that like, I have to have insurance because I have a condition. And as you guys know, I'm over 50 now. As we get older, that's when we typically start using our care more and claims get more. So you kind of get into this death spiral. And there's really, it puts you in a bad spot as an employer, because you really have to do a couple things. You either have to contribute enough one year that you're going to grab some of those young, healthy people, contribute, instead of the 50% of the low plan, you have to contribute 90% or something like that. And that's really, an employer can do that or they can't, depending on their budget.
Right.
There's also a strategy I was going to touch on. There's an HR strategy with individual coverage. I'll bridge into when you guys want me to. I can do it now or what, but that's another strategy that we're seeing take place as well too to use. So,
yeah, that was going to be my next question: is what types of things, and if we still stay focused on the under 50 employee group, what strategies do you like to suggest to businesses with less than 50 employees that need to offer a small group medical to help rein in? I'll get that out. Just give me a few minutes. It's Monday morning.
That's right.
Rein in the cost of premium, because a lot of small businesses, they can't afford to pay 100% of the employee's premium.
Right.
But I'm not so sure you really want to contribute 100% of the employee's premium at this stage. But anyway, what strategies do you like to look at for the under 50 group?
Yeah, Jeff, it's becoming more and more challenging. So in the traditional insurance market, the fully insured market, there's only so much carrier hopping you can do, right? We went with UHC. Let's look at if Florida Blue can come in lower this year, then you stay with them for a year. So really, for the right group, if it's a healthier group, and I wouldn't say younger, if it's just a healthier group, because it's all relative, you definitely want to look at level funding, right? Because again, if it's a decent claims group, we're seeing level funded come in a little bit more aggressive than the fully insured market. The other strategy that we've implemented, and we just wrote our third one here, so it's just gaining traction, is an individual coverage health reimbursement arrangements. So health reimbursement arrangements have been around since the early 2000s, and sometimes an employer would put a group plan in with a higher deductible and say, look, here's what we'll do as an employer. I'm gonna, let's say we have a $4,000 deductible. I'm going to reimburse you for the first $2,000 of that. You're going to do the second $2,000, or just whatever combination you want. But the health reimbursement arrangements are always employer funded dollars, and it's still a tax write-off for the employer to help offset some of the costs of insurance. So that's been around for a while. What the recent change has been the individual coverage health reimbursement arrangement. So as an employer now, this is directly to answer your question. A strategy that we look at now all the time is, look, here's what we're going to do, guys. You're going to go out to the individual market, all right, and you're going to get an individual policy. As an employer, I'm going to contribute either a fixed dollar amount to you guys all. So that's a way to control my costs, right? I'm going to say, look, I'm going to give everybody $250. You guys go out and shop. You want to buy a platinum plan, a bronze plan, that's up to you. You're getting $250, right? A more fair way I see it, and what a lot of people will do it, they'll say, for everybody in my company, I'm going to look at the low cost silver plan for you. Let's take that as an example. Because remember, in the individual market, every rate is based on, remember we talked about the 25 and the 55-year-old?
Yeah.
This is a little more equitable way to do it. So the low cost silver plan for you, I'm going to contribute 50% of that, or 60 or 25 or whatever. So it takes away a couple things. It takes away that 50% rule that you have to contribute 50% of the low cost employee only plan. You can come up with whatever you want. So that's a good thing too. But the better thing too is that it gets you out of the, if you're one of those groups that has a lot of conditions and you're in that death spiral, it gets you out of these 20, 30% increases, 40%, sometimes 50%. And it gives you a little bit more control from an employer of what you're mandated to contribute to. So it gives you a little bit more flexibility, and obviously you can make that more attractive or less attractive to your employees depending on your philosophy as an employer and what you're utilizing your benefits plan for. Like you said, Jeff, is it to attract employees? Is it to keep your good employees happy that you have now too? So
yeah, you mentioned level funded a couple of times. A lot of people may not be familiar with the level funded and the concept that, yes, it's partially self-funded. There's some claims element to that. Mm-hmm. But the more I learn about level funded, the more comfortable I get with it.
Yeah.
Can you just dive into the self-funded piece of it? Just real quick, give us kind of a 50,000 foot view.
Yeah. So you're exactly right. Level funded is really a type of self-funding, really. So, but I call it kind of a toe in the water approach. It's kind of a stepping stone possibly to self-funding. And anytime you're self-funded, you have a couple of protections for claims, right? You have an individual specific claim cap, right? Where you'll have stop loss insurance above that amount. Then you'll have an aggregate or total claims amount of protection where you'll have stop loss insurance outside of that, right? So in a truly self-funded model, you're paying claims as you go. So you might have a good month, 1 month, and not have to pay many claims. The next month might really sting and you might have $30,000 in claims, right? So level funded, what that does is that levels that out, right? I mean, that's why they call it level funding. So basically what you're doing is you're kind of pre-funding up to your stop loss ahead of time. So you're really funding worst case scenario, right? That's why you said you're protected. There's no, hey, you owe me more money down the road or later, anything like that. You're already pre-funding the worst case scenario or the total obligation up to your stop loss. Well, then at the end of the year, if you didn't use all those dollars, you get a possibility, depending on the carrier, of 100% of that back or 50% of that back and things like that. So that's kind of how that works. It is truly self-funding, and you're paying for those claims up to your stop loss and things like that, but you're pre-funding it, and then it becomes, and then they're dividing that by 12, and that's why it kind of looks and feels like a fully insured plan after that too.
So are those plans typically a little less expensive or a little bit more expensive because you're pre-funding your stop loss?
So typically, Bill, it's a great point. They're typically a little bit more expensive because remember, a lot of times they'll decline these groups for the wrong groups. Right. They just decline to quote them even. So they are cherry picking. They're definitely looking for good risk to write a plan like this for sure. So
and they're and they're basically doing full underwriting with that. With health statements and all that.
Depending on the size of the group. So some carriers will go down to even 5 now, which is great for us, so we don't have to, because you know how those individual medical questionnaires are paying. Some are 10, some are 5, but every carrier has their threshold of enrolled, not eligible. So if you have 10 enrolled, for example, that's enough of a population to they can, come up with some rates that they don't need those individual medical questionnaires. So
another thing that I find interesting with level funded is you get a plethora of claims data every month or every quarter. Now that can work for you or against you, because if you want to make a change, everybody that you want to make a change to, they're going to ask for all of that claims data, but it gives you some interesting insight as to the risk profile of your group. What are your thoughts on the claims data? How have you used that maybe on a proactive basis, kind of getting ahead of the curve, if you will?
Oh, man. So I think 3 big ones are, and I preach on this all the time, is use of emergency room versus when do you use emergency room, when do you use urgent care, when you can use a virtual visit. Jeff, there was a study recently, 25% of emergency room visits they think could have been handled by a virtual visit, by someone getting on their phone and just talking through it, and I could have just taken care of that. So you're taking
that's significant.
oh, you're taking a $2,500 claim, right, on your renewal and your on your insurance, and you're turning it into a $100 claim or a $75 claim, you know, with that virtual visit. So that's a big education that will speak to you. Okay, are we, you know, for your 10 employees, you know, why do we have 12 emergency room visits, you know, and things like that? So are they using the emergency room as their doctor? So there can be education there. You can look at prescription drugs. You can see how many people are using generics versus name brands. So you can do some data points there. And then I like to look at it like, are you really out of whack on you know, cholesterol or high blood pressure, or just something like that that's like a little bit out of the norm as well too? Because then maybe you can focus some type of wellness initiative or something like that to address something more specific as well too. So. And we spend a lot of time on that at Liberty Run here, educating people on the resources and tools that they have for free. A lot of times people don't even know it, that they have resources with the carrier a lot of times to maybe quit smoking or eat better or lose weight and things like that.
Yeah, and I think that, you know, I mean, we all know the debacle with COVID, but I think a couple of good things came out of that. I mean, first of all, we're all very comfortable now using, you know, these types of video calls, things like that. But the other thing is the teledoc.
Yes.
You know, doctors felt that they had too much liability by not seeing you directly and asking you the basic questions and having you come in and pay a copay. To where COVID, they kind of opened up the teledoc procedures, and you know, it's I think it's making medical a lot more efficient.
I agree, and there's some cost savings there. So many carriers will now have their telehealth service, whether it's a teledoc or something like that. But now I'm seeing even more like your primary care physician, your family doctor, maybe your specialist even will be able to do a virtual visit with you as well too. So. I agree. That was a positive move from the pandemic and COVID. Exactly.
Yeah. You know, there's a lot of talk and a lot of effort into educating employees and people who are insured in general about wellness, about using generic drugs versus brand names. But you know, you still have to change behavior. And one of the things I do like the HSAs, the healthcare savings account plans. There's a multitude of reasons that I like them, and I've gotten to know them quite well over the years. What is your take on the HSAs for small groups, and how do you work those into the strategy?
Yeah, I'm a big fan as well. I'm anything that's for, you know, kind of personal engagement and just being an advocate for yourself and responsibility for yourself. I think we need more of that in our healthcare system. I think we've gone too long of just like, you know, floating through and just doing whatever because, you know, whatever I'm told to do and things like that. But I think the HSA, you know, now you have some skin in the game, really. So your decision of whether should I use the emergency room right now, or could I do a virtual visit? Well, now that's actual dollars. Do I want 2,500 or whatever, you know, if it's after deductible, very well could be a $2,200, $2,500 payment from your health savings account versus my $50 copay that I had on my virtual visit. So I think when you give people skin in the game, and they have, and we can get some competition going, like our regular free market, like our healthcare system is the opposite of the grocery store, right? Like we go to the grocery store, we look at prices and what's on sale and look at the ingredient, who's got the best quality, right? For the best price is going to win. Well, that's not really in our healthcare system. So we have no competition. So if we can instill a little bit into that, whether it's, you know, this MRI may cost me $1,200 over here, I can get it for $700 over here. Because it's my dollars now, I think that's a good thing. I think if we competition is always good for the end consumer, right? The person with the best service at the best price should win. So I'm a big fan. And as you know, the HSAs are not use it or lose it, right? So you can roll over those amounts year after year. So if you can start that, like how many times have I told my kids, start your 401k as soon as you can, right? Start it with, you know, and some of us do that, some of us don't, but it's similar to an HSA plan. If you can start it in your 20s and put together, you know, 10 years or so and put 2,000 or 3,000 in, you might have 20 or 30,000 in that account, earning interest and making money for when you do need it down the road as well too. Right. So yeah,
Yeah, especially if you're young, and also how to work. And I don't want to say this negatively, but how to work the system though, helps with the HSAs, because I had an MRI the other day, and it was going to be $1,000 or so if I ran it through my insurance. I was like, well, I'm just going to cash pay.
Yeah.
And it was $300.
Yeah. Look at that. There you
go. I mean, I saved myself $700 just by not even worrying about my insurance. It's $300. You can do x-rays for $50. So, if now that you're on the hook for the first, $6,500 of everything, including strips, it makes you
a better consumer. Yeah, it makes you a better consumer.
Exactly.
Sure.
Yeah, and from an employer's perspective, the HSA, typically the plans, if you measure up a $3,000 deductible PPO with copays versus an HSA with $3,000 deductible, the HSA plan is going to be considerably less in premium. And I try to encourage the employer to make a contribution to the employee's HSA account, because it incentivizes them. It helps them reduce their deductible. The employer is going to save money on the premium. It's you rewarding employees also, especially those who are healthy, to sign up for the HSA. To me, it just seems like, well, if you're going to have an HSA and you don't contribute to the healthcare savings account, don't get into one.
I agree.
You're missing the point.
Yeah.
Right. But to me, a good strategy is to combine an HSA with some traditional copay plans, but get the employer to make some kind of a contribution to the HSA.
Yes, I can't agree more, Jeff. So yeah, it is a great low plan strategy that the employer can kind of base some cost share on that typically. So it's a lower than a 3,000 PPO plan, like you said, versus an HSA plan. And then at a minimum, allow the employees to payroll deduct pre-tax contributions to it, because that's a little incentive, right? You can, at the 25% tax bracket, you can put $100 in your HSA and your paycheck only goes down 75, right? So that you get those pre-tax contributions there. But if you can, the ultimate, I guess the ultimate, what I go for is having the employer contribute too, because then, I don't know how many times I've held up my HSA card in a meeting and say like, hey, your employer is putting $50 a month on this, or $25 or whatever. So when you go to the doctor, you use this. And a lot of times a light bulb goes on, like, now I get it. Okay, I'm paying for my expenses with my HSA. So that does help. And that's a great strategy, Jeff. I agree.
Right. Yeah, I had been on an HSA for like 3 years, never used it.
Yeah.
So I had, and then last year I started doing some preventative stuff, and it was costly and it wasn't covered by my insurance, but
sure,
they would accept my HSA. So
yeah. The other advantage, you guys know, you can use it for dental, you can use it for vision, you can buy eyeglasses. A lot of it's publication 502 or 213D is the tax code, but publication 502 is the one in English, I say, right? The one that's easier to read, that lists all those.
You can also use it for cosmetic and things like that are not covered by insurance, right?
There's some rules on cosmetic build you'd have to look at there too, but they fine tune. But there are some things like they've expanded it to like Claritin D and things like that. If you're like sinus medication and just some of the over the counter drugs and things that you can buy as well. So yeah.
Do they audit that?
I mean, I would say no. A lot of these cards that they give you are quote unquote smart cards that by the code they're supposed to work or not work if it's an eligible expense. So a lot of times they have it dialed in for you. But technically, if you bought a 6-pack of beer with your HSA card, unless you got audited, they'll never find out, right?
Well, it's funny you say that, because my chiropractor with one of my HSA plans, they couldn't accept it. It wouldn't work. Then when the company I was with for benefits changed the HSA,
Gotcha.
it worked. And I don't know if the chiropractor just changed the code or what, but I went a long time without being able to use it there. So
that's interesting. And you can always with an HSA, another cool thing is you can pay out of pocket and you can actually reimburse yourself from your HSA too, which is kind of neat. So if you're ever in a situation where you just don't have the card with you or something like that and have to pay cash, you can always just reimburse yourself, keep that receipt, and like your other tax receipts, and reimburse yourself as well.
Now what?
Go ahead.
I was going to say, what's the difference between an HRA and HSA, and when's the best time to use it?
Yeah, so an HSA is a health savings account. You have to have a qualified health insurance plan, a specific type. Like Jeff said, everything has to be after the deductible, but except preventive care, right? That's the only first dollar coverage you can have is preventive care. So the true advantage is to be able to put away that tax-free money every year that rolls over year after year after year. And the cool thing about the HSA, that's your account in your name. So that's the big difference, Bill, on the HSA. The HSA is in Bill Rose, that's my HSA. If I ever leave that company, I still have my HSA to use. I just can't contribute anymore unless I have one of those qualified health plans, but I can use it out as long as I want to. Gotcha. The HRA is always employer dollars only. Okay, so the health reimbursement arrangement is something that the employer just sets up. Now you do have to. It is under ERISA, so the HRA is recognized as a health plan, right? That you have to, follow the ERISA rules, and you have to offer COBRA and things like that for the HRA portion, stuff like that. But that's employer dollars, and it's dictated by a plan document that sets out the rules, and everybody has to have a summary plan description. Where we run into a lot is employers who just say, you know what, I like Sally, I'm going to pay for her individual insurance, and then I'm going to do half for this person. And man, you're exposing yourself to a liability nightmare, because I always say everything's great when everything's great, right? And everybody's happy and working, but then until one person gets disgruntled, they're going to say, I heard you were doing this. So if you're doing something like that, an individual coverage HRA, or an ICRA is the acronym for short, it's a great thing to do, just to kind of put that in writing. Okay, here's what we're doing as a company. We're not discriminating. We're giving everybody $250 for their individual premium, things like that. So,
all right. And forgive me if I missed this, but with the HRA, it does not go with you. It stays.
That's correct. You can put some rollover provisions into your plan, but it's all employer dollars. That's exactly right.
So if I were to leave my employer that had that plan, it goes back to the employer?
That's exactly right. Yeah.
Okay.
Yeah.
Okay. So that's a benefit for the employer.
Yeah, absolutely. Yeah. So, and a lot of companies they'll put in, if they're putting a traditional HR where they're covering some deductible, that's kind of set up by a third-party administrator that deals with this all the time. The individual coverage HRA, you're usually putting out a set premium amount that's no more than 100% of the premium anyway. So there's typically nothing for the employee to take with them after that anyway. So,
yeah.
Okay.
Hey, if we turn our attention to the applicable large employer, those groups that have 51 employees and up, the game's a lot different than the under 50. Can you touch on some of the differences between the small group and the large group?
Yeah, I mean, the biggest difference in the fully insured market, Jeff, is the underwriting portion, right? So when you're getting into 51 plus now, then the groups are medically underwriting, similar to what they are in level funding, right? So, but when you're an applicable large employer, so you have 51 or more full-time equivalents, right? And there's formulas that can determine all that, which we help clients with all the time. Then there's a couple things. So you're offered not only to offer minimum value coverage, which is basically a bronze plan or above, which most carriers, they don't have plans that are under minimum value. So you don't have to really worry about that. But you also have to make it affordable now for the employees, which the IRS changes affordability every year. For 2025, it's no more than 9.02% of household income. And then they allow 3 safe harbors, you can do that, which are rate of pay, W-2 income, and the federal poverty level. So we work with employers all the time to figure out who's eligible, who's not eligible. Here's your different options to make this coverage affordable for the employees, to help them determine which is best for them too. But yeah, I get asked a lot, now that Trump president, did the ACA go away? It's like, no, it's still the law of the land since President Obama. Nothing. The only thing that's gone away is the individual mandate to have insurance as an individual. But
right,
all those laws of 50 plus are still the law of the land, and they've never changed since the Affordable Care Act. So.
Man, that's an interesting point, Steve. Billy and I, this case that we were working a couple of months ago, they're actually, because they're in that death spiral, they're an applicable large employer. Yeah. They've only got about 30% participation. There's no there's no light at the end of the tunnel for this group. So they're contemplating just doing away with an employer-sponsored medical plan. So they're contemplating the penalties that they'd be charged. And they were under the impression that the employer mandate has been waived, but that's not the case. The employer is still subject to the penalties for not offering affordable medical coverage.
Correct.
One of the other things too is employers have to file this 1094, 1095 thing every year. I guess that's to prove that they're in compliance. It just seems like the compliance level takes a big jump up with the applicable large employers now.
100%, Jeff. So those 1095s for an applicable large employer, in a small group, those are provided by the insurance carrier typically, right? There are a couple of new, there are some level funded carriers that you still have to do it for, but in general, if you have an individual policy or you're in 2 to 50 eligible market small group, those 1095s or 1094s are provided by the insurance carrier. As an applicable large employer, it's your responsibility to provide those to your employees, okay? And that just shows that you did offer minimum value affordable coverage and what method that you used, right? The rate of pay or W-2, things like that, and that they had it available to them every month. So we are seeing companies get penalized now. The IRS is 3-4 years behind. So right now, someone might get a letter, a 226J letter from the IRS saying, in calendar year 2022, we see that these 7 employees got a subsidy on the exchange. Why didn't you offer minimum value affordable coverage? So they put the onus on the employer to prove all this. So again, more resources, more time have to be put toward this. And then you have to go and show, yes, they were offered and they waived. So then the IRS now is going back to them now and auditing these people we're hearing. So it's starting to catch up. People thought, the put my head in the sand and hope this goes away approach, I would not recommend, because it's catching up with people now. So.
Now, does common ownership amongst companies have to play with the?
It does. Really, yeah. It's just like the 401k rules, basically. So, if you have,
I couldn't have multiple companies and just do what I want with each as a small employer.
That's right. So that they got on that real quick. So because people are like, I'll just stop at 49 employees. I'll set another company up 49, never hit 50. So
we saw that in the franchise market, right?
A lot of franchise. Yeah. So the control group is what it's technically called. And that's the same. There's certain ratios, and if it's less than 5, control more than 50%. So there's some pretty distinct definitions that you have to kind of, every case is specific because of who has what ownership in both and things like that. So, but we can help with that too as well. We do that for companies to see whether they're a control group. So,
you see it, we see it. There's industries and companies with well over 50 employees. They're just in an industry where you're not going to get a lot of participation in the health insurance from the employees.
Yeah.
So they're considerably less than 50%. In fact, I was working with a family office that had a large lawn maintenance landscaping. They had, a couple thousand employees, and their participation was like 10%. Mm-hmm. They really struggled with participation. How does the affordability rules and the penalties impact those entities that they just can't get to a decent level of employee participation?
Yeah, that's a challenge, man. And that gets back to the same death spiral that we see on the small group. It can be sometimes magnified on the large group, because now it's not just demographic driven anymore. So typically you have that same scenario where you end up, the insurance gets so expensive that only people that I have to have insurance because I have these conditions I have to have, I don't care what it costs me. And typically, unfortunately, those are your older people, because that's we all, in the over 50 crowd, that's who typically starts becoming the heavier users when you get up in your 50s and 60s, things like that. So you get into that death spiral. And I would encourage you to take a look at the ICRA. So that, before the ICRA, it was really tough, Jeff. It was really tough to get somebody out of that death spiral, unless the owner just ponied up one year and really contributed to get some of those younger, healthier people. And that's not a 1 year, that's not immediate fix too.
No.
That's doing that for a whole year to get the better renewal the next year. You know what I mean? So that's sometimes unsustainable. So we had a group, I'll just give you a quick, we had a fertility group out of Syracuse, New York, that had about 400 employees. They had 2 people on their plan that were costing $1.5 million in claims. And they're not supposed to know who they were, but they knew who they were, things like that. So to avoid any discrimination or anything like that, they went to the ICRA, and basically they said, hey, look, what we're going to do is we're going to pay a certain percentage of the low-cost silver plan to make it affordable. And there are guidelines for ACA and to make, to stay within the requirements of the Affordable Care Act. So what they did is, in essence, that 1.5 million that kept hitting their renewal every year, and they were getting 30%, 35, 40% increases with Blue Cross Blue Shield. They basically transferred that risk to the individual market. Now, will that catch up to the individual market? Maybe eventually, right? But typically the individual market, 5 to 7% increases per year. So we saved this company close to $1 million in their costs just by this flip. Now, does it work like that for every group? No, this was just the perfect setup that had a few people that were driving huge increases in huge claims. And then the ICRA made sense for them to flip that risk to the end. So from that point on, now claims are really irrelevant for this group. And when I said that to the CFO, they were like, wait a minute, claims are irrelevant, because he was really monitoring claims and how this was going to impact their renewal. So they just kind of flipped that risk to the individual market, and now their costs are more fixed every year.
So if I could just make sure I understand correctly, the whole group went to the ICRA plan?
Yes.
Okay. All right. Because I've heard some cases where you could laser a few of those.
Yeah, we looked at that bill first. So we looked at lasering these couple employees in there. So which really doesn't it doesn't help for cost, because really what you're doing is you're assigning much more risk to those employees. What it does is it keeps those people separate from your other population. That's really the advantage of lasering. So it's in case, they leave the company, that, just whatever, you've kept your other population kind of pure or clean a little bit. You didn't affect them. So lasering definitely can work in the self-funded model for certain risk. Doesn't really help you until that risk goes away, though. It really just keeps it separate. So the ICRA basically just allowed them to do a quick fix and solve that problem immediately by just saying, hey, you guys go pick your carrier, pick your plan design. Here, we're going to contribute X amount to everybody, and you guys pick what you want. So, and there's companies out there that make that somewhat seamless.
So when it comes to renewals, it's really all about the medical loss ratio versus premium dollars coming in, right? So if you're lasering some high dollar people, but even adding the HSA, you're actually potentially lowering your medical loss ratio. Is that not accurate?
So yeah, potentially. So what happens is when you laser those people, so let's say instead of a certain stop loss of 30 grand or something like that, you're putting a much higher stop loss on them. So you're keeping, I guess, from your cost perspective, you're probably keeping it about the same, Jeff. You're just keeping them separate from you're not letting them pollute the rest of the pool. Let's put it that way. That's the big advantage of lasering. So,
right.
Yep.
Hey, I want to go back to HSAs real quick. I meant to ask this question earlier. A lot of people don't like them because the deductibles are higher. Like I mentioned, I did 63, 50 deductible, whatever. Do you use any gap plans involved with that to kind of bring that down? And
yeah, so so some gap plans, you have a true gap plan you have to be careful with. But Bill, what's becoming more popular now are like hospital indemnity plans and things like that. Like some of these indemnity plans that maybe if I get admitted to the hospital, I get $1,000 cash, or I get $2,000 cash. So people are using those to kind of offset some of those deductible plans as well. And then we do sell traditional gap plans too that will pay a percentage of an inpatient or an outpatient surgery up to a certain dollar amount. But there are specific rules sometimes of whether you can put an HSA with those and pair those. So you just have to kind of pay attention to that as well. So
one thing that we see in the PEO world, at least, and it may be applicable to the open market as well, is companies establishing different benefit classes. Like executives might get 100% of their benefits paid for. First line managers might get 90% of theirs. Second line managers might get 80%. And then the staff might get 50% of their benefits. But there might also be a group that they're outside the benefit class spectrum and they don't get any health insurance. And I'm thinking back to lawn maintenance, landscaping, where turnover is very high.
Yeah.
A lot of those folks don't want to contribute anything to their health insurance. They, for whatever reason, go without it. Are the class structures available in all open market plans? Or,
yeah, they are. Yeah, they are. There are rules with highly compensated employees and non-discrimination rules of making sure you're not favoring highly compensated, but those highly compensated are actually defined by income and things like that. It's 150, 160. So you have companies that don't have anybody that fall into those. And I always just tell people, just make sure that the classes are well defined. You have it in writing, and you're doing the same for everybody within that class too. And I think, if you kind of adhere to some of those guidelines, you'll keep yourself out of trouble. We didn't. Jeff, you made me think of another thing. I don't know how you guys are doing on time. I'm fine here, but
good.
There is something called a MEC plan, minimum essential coverage plans. So you just, in those situations, the landscapers, maybe a restaurant group, right? You may have, a lot of your part-time, waiting staff and things like that don't make a lot of money. So MEC plans don't get you out of all the ACA penalties, right? The Part A and B penalties, but the minimum essential coverage. A couple cool things about it. They don't provide minimum value though. So they don't get you out of the Part B, but they all cover preventive care. And a lot of them have added, a few doctor's visits and maybe some discounts on some prescription drugs and things like that. So they're trying to make it look and feel a little bit more like a health plan and give you a few benefits. They might use like a PHCS network or something like that they rent as part of the cost, you know what I mean? And put that in there too. So MEC plans can be a good solution for, again, landscapers, in-home healthcare, hospitality, restaurant groups, things like that. That you can provide at least something of a benefit. So,
we're seeing those. Quite a bit. Restaurants.
Yep. You can throw out, so you can put a fully minimum value plan for your eligible staff at a restaurant. And then you can say, hey guys, as anybody, part-timers, we're going to throw this MEC plan and the employer can contribute. They don't have to contribute. There's a lot more flexibility on these MEC plans, but
gotcha.
Loud and clear, they're not like traditional health insurance.
Right.
Okay? So you got to be really careful to educate on those people. Don't think it's going to cover a 2-week hospitalization, things like that. So, yeah.
Well, Steve, any final thoughts, man? Anything that?
No, guys, I appreciate the opportunity to do this, and I think my own final thought. Hopefully this isn't controversial because it shouldn't be, but I just encourage everybody to take responsibility for their health. Like I always say, my goal is never to use my health insurance, right? In a dream world, I would love to do that too. So, man, I would just encourage everybody to do what they can to eat good and exercise and not have to participate in that system, right? If you don't like it too. So,
since you and I have kind of been hanging out, we both shedded some pounds and kind of done some preventative stuff and I'll agree with you there that if you just take a few steps of preventative medicine yourself and own it, one, you'll feel a lot better, but it'll also help you out in the long run. So
100%.
The last thing I would say to people is don't be afraid to call the insurance carrier. I think a lot of people are intimidated. They're a great resource. They will help you find the right provider. And they'll also help you find a lower cost provider. Same with pharmaceuticals.
Yeah, absolutely. And Jeff, there's a ton of tools. Like we really, and Bill, I can't remember the last time you've seen me do an open enrollment meeting. It's been a while, but we really focus on wellness and the tools available for not only for your personal wellness too, but like you said, to find in-network, to shop those MRIs, Bill, like you were talking about. Oh man, it's $1,200 over here. I can get it for $800 over here. So we actually, Lexi on our team is going to be our wellness coordinator, and we're actually going to tie that into our enrollment meetings and things like that. And really, we're going to have a dedicated resource at Liberty Run Benefits to go out and educate employer groups on things like that as well too. So, which we couldn't do in the past, but we just kind of implemented that starting this year, which is neat. So she's kind of taking on that role.
Well, that's good. Very good.
Yeah.
Yeah. Well, you got a nice family support system there.
Absolutely. Yeah.
Benefits. So, well, listen, man, thank you very much for taking the time.
My pleasure, guys.
A wealth of knowledge in the industry, and anybody listening, you could reach Steve at libertyrunbenefits.com.
Yep, absolutely. Yeah.
All right. So, very good, man. Well, thank you. And
thanks,
I look forward to seeing you soon.
Thank you, guys. Appreciate it.
All right.
Thank you,
Thanks, Steve.
Thanks
Bye-bye.
so much. Bye-bye.